let's get rolling again. I know that planning a budget sure doesn't sound as fun as flying by the seat of your pants approach that a lot of people have taken. But it's a lot less stressful at the end of the month, you know, and you're a lot better steward. And if you do it properly, you'll be able to live well when everyone else has gone belly up. I said there's a lot of things Dave Ramsey says I don't agree with. I'll point that out. There's a few things he says I do agree with. One of the things he says that I'm probably a good statement is live like no one else so that you can live like no one else, right? And that's not a bad statement. That's a good statement. You may need to make some sacrifices to get yourself on budget, and get yourself in the right direction. Okay. Now I disagree with his general philosophy on debt and some other things, credit scores and things like that. But I do agree that we need to be prudent, wise, budget conscious, and savvy individuals. Some things that'll kill your budget. Neglect. Just don't take care of it. Slothfulness. Just be lazy. Don't record. Don't be diligent about it. Wastefulness. It doesn't matter how big your food budget is. If you waste food, that, you know, if you over prepare and just throw a bunch away. Now, if you over prepare and you eat all the leftovers, there's nothing wrong with that. All right. When I was growing up, I swear my mother had a second family, a first family, really. They got all the first overs and we got all the leftovers, because I don't think we ever ate any but leftovers when I was growing up. Anyway, I told her that one day and she's like, oh, that's not true. But you ask my siblings, they all think the same thing. So, but what it was is there was always extra prepared, and then we ate leftovers, another meal or two meals, you know, whatever. That's not bad. But if you are just throwing stuff away, you're wasting resources, and what you're really wasting is money. Okay, so you need to be more diligent about that. Covetousness will kill your budget. Covetousness will kill your budget. Greed, following your lusts. Right? So those things, neglect, just not doing it at all, slothfulness, not being diligent about it, wastefulness, and covetousness, those will kill your budget if you're not careful. Doesn't matter how good plan you have, if you do those things, it's not going to work. Okay? All right. Any questions about budgets before we go on and start talking about credit scores?
What percentage of your income should you allocate to like a car? Do you recommend buying a new car, like a brand new off the lot?
No, I don't recommend buying new cars. You lose about 50% value as soon as you drive off the lot on a new car. So we bought a new car. Our Prius was a new car. I had the money and I wanted to see what it was like. I love my Prius. I certainly wish I hadn't spent as much money. I could have bought two cars for the price of buying that car. Now, certain times markets are what they are, right? And in 2020, the used car market, it was cheaper to buy a new car than a used car, which is absolutely absurd. But generally speaking, in a normal environment, you can get nice used cars, drive them for a long time, at half the price of per mile. So what you need to think about, this is my recommendation. Again, I don't feel like it in counseling terms, okay? I don't tell people what car to buy, you know, and all that. I try and teach them how to think for themselves, make those decisions. If you're asking this question, this is like a me opinion question as opposed to a Bible answer question here. But think about your cost per mile on a car, right? So if you buy a car, let's say that has brand new off the lot, and you spend $30,000, and you plan on driving that car until it hits 200,000 miles, right? How much did that cost you per mile? Not counting regular maintenance and tires. Someone doing the math on that? $30,000 divided by 200,000 miles. How much per mile? 15 cents a mile. That's not too bad. Okay. Now, let's do a different number. Let's say that we buy a car that is 150,000 miles. We plan on driving it until it dies, or we hit 230,000 miles. Let's just say that 230,000. So that's like what, 80,000 miles we're going to get on that. And for a car with 150,000 miles, let's say we spend $6,000. You could get a car for in that mileage for about that price. How much do we spend a mile there?
7.5 cents.
Okay. So how much was the first one?
15.
So about half per mile. So, I mean, there's a lot of factors when you talk about a car. For me, fuel mileage was a big factor because I was driving so far, I'm spending so much there. But it might be for you, there's a big factor, I know. You've got to have enough seats in the car. Okay, it doesn't matter for me. Angela and I can own a motorcycle now. We're good. Right? Just two of us and life is good. But you have to have so many seats, right? But then you know, what are you going to end up planning wise? Now, no, there's no guarantee that you buy a car at 150,000 miles and it runs till 230,000 miles. But there's also no guarantee that you buy a brand new car off the lot and it runs to 200,000 miles, right? So generally speaking, I try and look at what is my cost per mile on anticipated usage going to be, you know, so I kind of factor that.
Okay.
So it's not really about, because quite frankly, I spent $30,000 on my Prius when I bought it brand new. However, I told Angela, I looked at this, and many Priuses run to about 350,000 miles. That's very common. Okay. I looked at that number specifically. So tell me 30,000 divided by 350,000. And then I factored in, and I'm also going to get in gas mileage, I'm going to get 45 on average versus, 22, right? So I'm getting twice the gas mileage. What's that number?
8.5 cents.
So that was the number I based my car buying decision, because not only was I was going from, not 15 cents, I was getting 8.5 cents. And then I'm paying half the amount for gas that I would otherwise pay. So to me, budgets wise, it was like, well, this is a no-brainer. But I knew how far I was driving. If I worked right up the street right here and I'm not driving that far, that probably wouldn't have factored. I'd have bought a, work car. So I currently have like almost 150,000 miles on my car now. So I'm not quite halfway, in my view, I'm not quite halfway to being, done with my car, basically. Right. So that's kind of how I figured that. Yep.
Do you suggest doing a budget by the day, like first of the month to the last day of the month, or by week?
Good. That's a good question.
Because
So-
I can throw off with the teachers.
Yeah. Because what you have is you've got some bills that are monthly, but then your pay might not stagger quite the same way. So my recommendation is you should base your budget based on a month's worth of pay, but that might not be the first of the month to the first of the month. You know what I'm saying? So if you get paid on the 1st and the 15th, then that's pretty easy. But if you get paid weekly, then and this is a good thing to think about. Base your budget on 4 weeks, not 5. Right? So then every quarter you have a bonus check.
Right.
And so, basing your budget that way. But if you're just bi-weekly, that's what I am. I'm bi-weekly. So my budget is based on 2 checks. But that's not necessarily a month, within a month time. Does that make sense? Like,
Right. Some months you get 3 checks.
right. Some months I get 3 checks. Right. So 2 months I get 3 checks. So, is that right?
2 months out of the year, you get 3.
Yeah, 2 months out of the year. So anyway, that kind of gives if you base it on a normal month's worth of checks, it doesn't, I don't necessarily go date to date. I go check to check.
I just know some people would, they do your budget 4.5 weeks. Just that kind of thing, that was confusing.
No, I've always done my budget on a 4-week. And then we have bonus. And so with bonus, we think about vacation money, or we think about, birthdays and anniversaries, those type of things that we're going to spend money on. But that's not coming out of our regular budget. So. Any other questions? All right, let's talk about credit scores. Woohoo! It is common among Christians to be so anti-debt that they don't care about their credit score. And that is not a healthy way to look at that, in my opinion. And I've already said this, so, it is what it is, but I disagree with Dave Ramsey about this. He calls credit scores "I love debt ratings." And that's, I think, harmful to people's understanding of things. I think he hurts people with that advice. Now, I do know this, and this is what I try and be gracious about this. I'm being very direct about it, but I'm also trying to be gracious about this. People like Dave Ramsey have said things like you don't need a credit score. But most of the people that start listening to Dave Ramsey have lots of credit card debt. And they don't have a credit score anyway. Okay. So in some ways saying, hey, don't worry about your credit score, focus on paying off your debt. Well, if you pay off your debt, your credit score is going to increase. Okay. So that's a positive thing. But at the same time, I think it's foolish to say don't think about your credit score, because it is an important thing in our system, in our culture. And so let's talk about a few things that regarding your credit score that you need to know, that everybody really needs to know about your credit score. Some things that are affected by your credit score every day, right? Your utilities, the cost of, your deposits for utilities and all that type of stuff, that's affected by your credit score. When you set them up, you sign a credit contract, in essence, for providing them for your gas, electric, water, and so forth. And you agree to pay the services after they have provided it, which is why your credit score matters. And if you have bad credit, the company might require you to have a prepaid account that charges you more, or they might require you to provide a large deposit. I talked to someone the other day that had to pay a $400 deposit on their to get electric service. Okay, and that's a lot of money up front that you're never probably going to see again if you plan to stay in your home forever, right? But if you have good credit, you can provide a letter of credit. And a letter of credit is basically your credit score, or maybe it comes from your bank or various different places, or a company that you have good credit with, and they send a letter and they just say these people are diligent paying, and they're trustworthy, and then they just file that letter of credit and you don't have to pay a deposit. All right, but that's because you had good credit. That matters. Just like your other utilities, your phone, your internet service is all based on credit score. Without a good credit score, you might not be able to get service at all. As a matter of fact, there are certain internet and phone companies that if you have bad credit, they just will not cover you. And they'll say, sorry, go get an Obama phone, because you can't have our phone.
What's an Obama phone?
It's a government phone. You didn't know that they
I
had,
never heard of it.
yeah.
They mean,
You've seen them.
Like every quarter.
Yep.
they mean that pay for it?
Yep.
Wow.
That's crazy, isn't it?
Sad.
Yep. Anyway,
Didn't know that.
I think they come with a direct line to the NSA as they listen to all your calls too, but in no way I'm talking on a phone given me by the government. I know they listen to enough. They're listening right now, aren't they? I'm just kidding.
Get started.
All right. Another area that's dramatically affected by your credit score is your insurance premium. Statistics say that if you have a credit score under 580, which is considered very poor, by the way, okay, very poor, then you'll pay an average of $2,887 a year for your car insurance. This is in Oklahoma. Right. Credit score under 580, you're going to pay an average of $28.87 for car insurance. If you have exceptional credit, somewhere between 800 and 850, you're going to pay an average of $1,350. That means for having bad credit, you earned the privilege of paying $1,537 a year more. All right. Well, that doesn't make sense. I don't have as much money, so they shouldn't charge me more. Well, they're charging you more because you're poor with money, and they don't trust you. They think they may not pay, right? And then we're going to end up being out money on this. That difference is even if you have the same driving record. If you have a perfect driving record, you're still going to pay that much more. And so there are a few states that ban credit-based insurance rates, but not many. Most of them use a credit-based insurance rate. On top of those issues affected by your credit score, did you know that many businesses do a soft credit check as part of an interview? And if you have bad credit, you might not get hired. It might cost you a job if you have bad credit. And that's very often done if you'll be involved in handling money. If you're going to be a teller or clerk or whatever. And it's not uncommon for a business to reject a person based on that poor credit score because they're a business risk. That they're not diligent with their own money, they're not going to be diligent with mine. All right. If you're lucky enough to get a job while having poor credit, you might find that many banks even check your credit before allowing you to open a checking or savings. And I'm not just talking about credit cards here. It is possible, having such bad credit, that there are some banks that will not allow you to be one of their customers. Can you imagine going to the bank with a check and saying, I'd like to open an account, and them saying, sorry, we don't serve your kind here. You have too bad a credit. You go to Walmart to cash your check. That's what Walmart does. And you know what you do? You pay a really high fee to cash your check because you don't have a bank account, because the bank won't service you.
Thank you
Because
for paying that though.
yes, you're welcome. I don't pay it. I'm not going to do that. All right. Add to that fact that if you have to own a car to get to work, you're going to pay a much higher interest rate if you have bad credit. It's not just a matter of that, but you also might not get approved. And if you go to these places, hey, no credit needed. Well, you're going to pay an exorbitant amount of interest. That's how they make their money, because you're high risk. And you're going to pay a bunch of money up front. And I'll tell you, I know how this works because I know someone that owned one of these kind of lots. All right. And I don't say that this is that they're wrong, because these people are very high risk. But they buy cars, they require enough down payment to pay what they owe in the car. And then they charge the difference plus a very high interest rate, usually at least double of the normal interest rate. Okay. But what they know is, if these people blow this car up, at least it didn't cost me anything. Right? And then they're going to make money. Often they have to spend money to repossess the cars and various different things like that. That's a whole business in and of itself. But you're going to pay a lot more that way, and you're not going to get as much of a car. Okay. Finally, try to live anywhere without good credit. Go rent a place. You're not going to get into any place. You have to have good credit to be renter here. Can't buy a house. If you do buy a house and you have bad credit, you're going to pay much more than if your credit was low. The difference in a home loan for someone who has a credit score in the high 700s versus someone whose credit score is in the low 600s can literally be hundreds of dollars every month that you're spending if you have bad credit. Okay. Over the life of the loan, it could cost someone with a low credit score tens of thousands of dollars more because they didn't take care of their credit. Now, like I said the other night, if you're a millionaire and you can buy a house outright, that might not matter to you. But if you're in this class, it probably matters. Okay. And if you're helping people in counseling with finances, it's because it will matter, right? They need to understand how expensive it is to have bad credit. It is very expensive to have bad credit. And so you want to fix your budget, fix your credit. And a lot of your expenses will go down. Yes.
Is bad credit the same as no credit?
No.
Okay.
No credit's worse than bad credit. But and it is important as a parent to help your kids I didn't know this because when my kids were still at home, I read Dave Ramsey books.
Me too.
And I told my kids, you don't need credit. Dave Ramsey says it's bad for you. Right?
Me too.
And
Yeah.
this is partly why I'm so adamant that this is wrong. And I've been so emphatic about it because I hurt my kids. There's no reason my kids should have had to pay $400 a month for insurance. You know why they had to pay it? They had no credit score. And they couldn't provide a certain level of grades. This was one of my boys. Couldn't provide a certain level of verification of grades. And so he had to pay this crazy high. And I did not know it was because I hadn't done anything to help him build some credit. Okay. Because I didn't know the importance of the credit score. Anyway, nonetheless. So no credit's it's very difficult. You're going to pay a lot more with no credit. And so help your kids learn, first of all, you ought to help your kids learn how to manage finances. Part of that is learning how to build a credit score. So now we know that. A little late for my kids, my grandkids, who are more important anyway. So, right. Yeah, right. Okay. All right. So there are 5 factors that determine your credit score. So this is what you need to know about credit score. 5 things that determine your credit score. Number 1, and most significant, is your payment history. 35% of your credit score is determined by payment history. If you have late payments or have defaulted on debt in the past, it will decrease your credit score. So the number 1 thing you can do to improve your credit score is pay on time. That's number 1. Just pay on time. And so it's important when I'm doing counseling with people that are struggling in their finances, they're all messed up. Let's find out when are your bills due? All right? And we line those out when each thing is due and when do we need to send the payment. What check does that payment need to come out of so that it's early and not late? And just fixing that will start to repair your credit score. It takes time. It's gradual, but that will start, okay? If you are late on any payments, the first thing you need to do is catch it up. Catch up any late payments, call them. Let me tell you the number 1 worst thing you can do with late payments or debt is ignore them. You should be the most communicative person on the planet with them. You call them. You talk to them. Say, well, it's embarrassing. Yeah, it may be embarrassing, but it will get fixed. And they will have way more help for you than you imagine. They want you to pay. But if you don't call them, they think you're a deadbeat. And they're more likely to turn you over to collections and all that type of stuff. Okay? So you've got to really be diligent about catching up late payments and starting to pay everything on time or early. I really think that online bill paying is one of the best things for most people. It was for me, okay? Because I'm never late. It's an auto payment, and I don't ever have to. I don't forget about it. It's always there. Comes out, and I just know that it's coming out, and I keep it recorded. Okay, so that's a very important thing. Number 2, the amount you owe compared to your available credit limit represents 30% of your credit score. You say, what's my available credit limit? That's how much you could owe or could borrow, if that makes sense. So let me say it like this. So let's say that you have a home and you borrowed $200,000, right? But your current balance is, $140,000. So the difference here is, 60,000. So there's a credit balance there, right? Like if this was 200,000, then that loan is maxed out. Does that make sense? But as that comes down, then that reduces your credit usage. You have this much, but you're using this much, right? Now let's say you have a car and you borrowed 30,000 on the car and you still owe 8,000. That difference right there, credit usage. Does that make sense? Okay. Let's say you have a credit card and your credit card limit, how much you could spend, is just for simple 10,000. Okay. And you have a balance of 2,000. So you have an $8,000 difference in that usage. Okay. If these numbers, the closer these numbers are to this number, the more it impacts your credit. Okay. And so you want low usage. You want, if you have a credit card that has 10,000 available, you don't want to owe 9,000 on that credit card because it'll lower your credit score. Okay. And the lower, the higher or less difference there is, the more it impacts your credit score to the percentage of 30%. That affects your credit score. 30% of your credit score is determined by this right here. Your credit usage.
So when you have the option to raise your credit card limit, should you do that?
It's a good thing.
Okay. I've never.
Yep. It's why? Because it raises, not that you plan to use it.
Yeah.
I have a credit card. I have 3 personal credit cards, and I have a church credit card. My church credit card limit is $50,000. We never carry a balance on that. Okay. I have a credit card that I have a credit card limit of 20 some thousand on it. I don't carry a balance on it. But what happens? Well, I do use it to keep it active. We'll talk about why that matters. But I keep it active. Okay. But I always have this buffer of, $20,000 of my credit usage that way. And on the church card, which is actually on my personal number also, I have this $50,000 buffer basically to where my credit usage is always very low based on the amount of credit potential I have. Okay. Hold on. He was next.
Well, I was gonna ask about credit usage. Like, should you carry a small balance?
No, you don't need to carry a balance. You really don't want to because it costs you to carry a balance. Okay. But you do need to use it to keep it active. And we'll talk about why that, because that actually, length of time affects this too. I'll get to that in just a second. So you want to keep accounts open, generally speaking, the longer they're open, the better they are. Okay. And raising your limit is a good thing. Generally, they want to raise your limit when you're not spending money.
Yeah.
And then you're like, sure. Don't tell them no, because all it does is add to your, it reduces further your usage, and that increases your credit score. Yeah.
It may be something we're going to cover, but when you pay something off that you've owed something on, it decreases your score.
It does.
So I'm trying to figure out how that plays into that.
Yeah. So it's interesting. If you pay off your house early, okay.
If you pay it off, period.
Yeah. But when you pay it off, your credit score just does this yo-yo thing, But it'll equalize again. But yeah, if you pay off an account and close the account, that hurts your credit score.
If you pay off a credit card, it does the same thing.
It doesn't. Paying off a credit card doesn't close the account.
Not if you close it, but if you pay off your credit card,
Mhm.
if you've had a balance, it lowers your score.
Temporarily. Only temporarily. It raises back higher quickly after that.
It's time to use it. It's just the point. They want you to use it.
They do. And that's why I use mine for regular expenses. Okay. So all of my bills actually come off of my credit cards. And then I pay my credit cards.
Hoping that you don't pay it off.
That's what they hope.
Yeah.
But they give me points for having the card. They keep raising my balance so that it creates more of less and less overall usage, credit usage, and overall it improves my credit over time. Okay. You had a question next? No? Okay. Yes.
My house or loan payment, it says that if we pay it off sooner, there will be no penalties.
That's
Is that
true.
Is that what that's talking about
No.
when you're saying that?
No, that just means there are some loans that say you can't pay that, if you pay this off early, you still have to pay this much interest.
Yeah.
All right, so no early payoff penalties means that you can call your mortgage company today and they'll say, this is how much it would cost you to pay it off today to the penny, and we won't charge you an extra fee to do that. So that's a different thing.
Okay.
I'm not, by the way, please understand, I'm not just endorsing having credit cards. Okay, if you can't control your spending, don't open credit cards. Seriously, get control of yourself. But if you can control yourself, having credit cards is a good way to manage your money. Okay, and it's an effective way. It's safer than using your debit card. It's safer. Okay, especially if you travel. Okay, that type of stuff. It's an important thing. All right, number 3. So this represents 30%. That's called your debt credit ratio. And if your debt is above, here's the number. If your debt is above 30% of your available credit, it starts to lower your credit score. So it affects your score. It's 30% of how your score is affected, but and the 30% number also applies to your ratio. So you want your actual debt to be less than 30% of your available credit limit. Does that make sense? Number 3, length of credit history is 15% of your credit score. And when we say length of credit history, someone who just graduated high school might not yet have a credit history, but the longer your history is, the more it helps your credit score overall. And then, so as you know, I'm at 49 years old now, and I've had bad credit for the first number of years because I had no idea. And then I hurt my credit by following some dumb advice and stuff. But the longer you keep good credit, the better your credit goes up. And that affects 15% of your score is affected by the length of credit history. Okay. Then 10% is newness of your credit or your credit score. It's not always good to cancel a credit card because the longer you have that line open, the more it helps your credit score. So the Dave Ramsey thing, cut up all your cards and all that, that's actually going to hurt your credit. Okay. I have a credit card that I've had for 14 years. Same account. And that credit card, that length of time, it helps my credit. It's not significant, 10% of my credit score, but it's something. Every percent helps, right? And so I don't recommend, if you open an account, be careful about, that's why you need to be careful about opening lots of little accounts, because that can really affect your credit score. Yeah.
There's also inquiries.
Yes, we're going to get to that actually. Hard credit checks, you can have up to 3 a month, or 3. No, how many? I have it here in my notes. All right, number 5. This is the 5th area. Is that type of credit you have factors into 10%. Type of credit. All right. To be honest, this is what everybody says, but it's also, they also say they have no idea how the different types of credit affect this, but everyone says 10% of your score is based on the type of credit. And so essentially there's 2 types of credit. There's revolving credit, that would be like a credit card. And then there's installment credit, that would be a traditional loan. And I'm not kidding, I looked everywhere to see, and everyone says, we don't really know. We don't know which one is better or how much it affects it. We just know that it affects it by 10%. How they know that and not the other, I don't know. But I would guess that installment credit is worse for your credit than I'm sorry, revolving credit is worse than installment credit. In other words, I would guess that that credit cards probably don't help your credit as much as a home loan. Okay.
From what it was explained to me when I was buying my house, they said on that part was the balance of it. Like if you have, like a mixture of it, then that improves your score.
Yeah.
That was what they explained.
Yeah, but no one can, I couldn't find any explanation as to how it affects it by 10%. It just, that's just what they say. It's like, I don't know. So, okay, yes.
Is it wrong of me to think, since Irina's from Belarus, she has no credit score at all? Is
She
it
needs
wrong?
to.
So, just,
You need to help her
Get
build
her.
a credit score. You can do that by putting her on some things that you have
like
loans
you're
on.
saying about the revolving, would that be good?
In any fashion,
Sure.
you need to help her start building credit. It is good to have credit. It'll help her. What if something happened to you? She needs to be able to take care of things. If she doesn't have any credit, how's she going to do that when you're gone?
Okay,
You understand what I'm saying?
yes, sir,
Okay.
that makes sense.
Okay. So your credit score can range from 300 at the low end to 850 based on the factors we just talked about. 300 to 850. And for reference, here's what those numbers mean. Anything less than 580 is considered poor credit. It means you're a very risky credit. Okay? 580 to 669 is average. That score puts you just slightly below the national average, actually. But it's
580 to what?
580 to 669. All right? 670 to 739 is considered good. That's the national average plus just a little bit. It's considered good credit. 740 to 799 is considered excellent. And more than 800 is considered exceptional. Okay. So my kids, humorously, here several months ago, had a bet on, I say bet, they didn't actually bet anything, but just, they had a, because they're kids, they're siblings, they have competitions with each other about everything. And so a few months ago, their competition was who had the best credit score. And so they were all snapshotting and sending out their credit score on there. And I was proud of them because for the most part, they had very, very good credit. So anyway, but it's something that matters. It matters to have a good credit score. And so you want to have as good a credit score. If you can get your credit score up over 800, you should do it. Okay. And you should work to that end. And how do you do it? Well, I gave you the 5 things that affect your credit. Start being attentive to those things and you'll raise your credit score.
Does if you have a credit score and your spouse have a credit score, does it affect both of you?
No, each person's credit score is
It's-
independent.
It's independent?
Yep.
Okay.
That's why Irene needs a credit score.
Okay.
All right. So real quickly, and then we'll be done for tonight. There are, I say real quickly, I'm going to do this as quick as possible. Okay. 6 main things that hurt your credit score. 6 things that hurt your credit score. First and biggest issue is late payments or defaults. Always make sure that at least the minimum payment on your credit card or loan is made. I recommend setting up auto payments so if something happens, you don't ever miss a payment. Right? Number 2, closing a revolving credit account. Remember, part of your credit score is usage to available credit ratio, and if you have a credit card and keep the balance paid off monthly, the open line of credit increases your available limit and thus decreases your overall usage rate, and so that actually helps your credit. Another way that closing an account can hurt you is that it shortens your credit history length. Okay, the longer that account's open, the better it is overall. Along with that comes a third issue, which is keeping high balances on your credit accounts. You want to pay them down as much as possible. Now, on a mortgage loan, your big goal in a mortgage loan it is not necessarily just paying it off, although that's great. Paying off is great. but getting it below 80% is a key thing. Once you get below 80% on a mortgage loan, you no longer have to pay PMI insurance and you save money every month. Anything over 80% on your loan, you have to pay PMI insurance. It costs you every month, and that'll save you every month on your mortgage payment. So getting below 80%. And if you are below 80%, you ought to check and make sure that you're not paying it anymore. If you don't purposely take it off, they'll keep charging it. But you don't need it if you're under 80%.
You get refund?
No, they'll quit charging you. So, but you ought to check. See, am I under 80% on my loan? And if so, have they canceled my PMI insurance? Okay, so that's a way to save money. Remember, the goal or the target is 30%, no more than 30% of available credit limit. Okay. The next factor that hurts your credit is having errors in your credit report. Even if you do everything right, someone can open a fraudulent account in your name or hack an account and go on a shopping spree. When that happens, it can cause errors in your credit report. It's even true that some businesses can report things that are not accurate. When that happens, you need to dispute it for the sake of your credit score. You have a right to dispute items and can do so by phone or by certified mail under the Federal Credit Reporting Act. The Credit Bureau has to open an investigation if you report it, an inaccuracy or incomplete records. And if you wonder about how to do that, just go online and ask Google, and it'll pull it up. It's not hard to find. Fifth issue that can impact your credit score is constantly trying to find better rates. And this was mentioned a moment ago. Every time someone does a hard check on your credit, it counts against you. And there are exceptions for same product things within a 14-day period. If you're looking for a home or a car loan and you check a couple companies within this 14-day period, it's considered the same hit. So it doesn't hurt your credit. Does that make sense? But after 14 days, you do it again and it hits your credit. And if you're doing a house and a car and a credit card, those all count separately. All right. So the more hard checks you have, the more it dings your credit. Finally, avoid co-signing on loans. Co-signing hurts your credit. It might seem like a nice gesture, but you should really think twice about it for two reasons. One, if they don't make the payments, you must. Okay. Not to mention, having a shared financial obligation can strain a relationship, cause problems. Second, if there is a Bible admonition against co-signing, and that's probably to me the most important. Proverbs 6, verse 1 through 5 says, "My son, if thou be surety for thy friend," that means you've co-signed for him. "If thou hast stricken thy hand with the stranger, thou art snared with the words of mouth." What's that mean? Stricken thy hand with a stranger. Here's a stranger, your friend wants something, but the stranger says, "Well, I need some additional guarantee. Will you co-sign?" "Yeah, I'll co-sign with him." That's exactly what that means. Okay. "Thou art snared with the words of thy mouth. Thou art taken with the words of thy mouth. Do this now, my son, and deliver thyself when thou art come into the hand of thy friend. Go humble thyself. Make sure thy friend. Give not sleep to thine eyes, nor slumber to thy eyelids. Deliver thyself as a roe from the hand of the hunter, and as a bird from the hand of the fowler." He says, listen, if you co-signed, you should just go make sure that gets paid off yourself, because it is not worth the stress of having that hanging over your head. That's what the Bible says about it. All right. So guess what? Don't do it. Just don't co-sign. All right. Finally, how do we improve our credit score? All right. Start, get a copy of your credit report. You can get a free credit report from any of the three major bureaus: Equifax, Experian, or TransUnion. Those are the three credit reporting agencies. Your bank might offer that service, or if you have a credit card that has an app, it might have information on my credit. My credit card apps, I have on my phone. They tell me what my credit score is, and I can get my credit reports off from my credit card company. I would not go online and just type in free credit report and give your information to people. Okay, go to your bank, contact the credit unions or credit reporting agencies, or use that app. You give your information away and you're doxxed. It's not a good idea. All right. Then once you get your report, make sure that there are no errors on your credit report, and if there are, file to amend them. Next, prioritize catching up outstanding payments. The later the payment, the worse it hurts you. The damage goes in 30-day increments. Okay, so get the oldest ones caught up first and then catch up the younger ones as quick as possible. Third, pay off your credit card debt. Those are likely the highest interest rates as well. So it can be difficult to make headway there, but the best method is make the minimum payment on everything and apply as much as you can to the lowest balance and get it paid off, and then roll that, what you're paying on that, into the next one. Larry Burkett is actually the one that developed the method that was popularized by Dave Ramsey called the debt snowball. As you pay off the lowest balance, you just roll that to the next one and the next one until you have everything paid off. Okay. Finally, make sure and pay your bills on time. Remember that missing a payment hurts your credit score, so don't do any more damage. Now, if you do those things over time, you can improve your credit score, and it can save you serious amounts of money. Having a good credit score is also a good testimony and an evidence that you're an honest person and God commands you to be so. So that's the credit score lecture. All right. Children, we're dismissed for the night. And we will resume at 6 p.m. on Thursday and start again.